All right, so 2022 was just honestly crazy. And obviously in 2023, the beginning of this year has kicked off even crazier than 2022 had. And I am so glad we pumped so much money into the market in 2022. Actually, the most amount of money I have ever put into the stock market was put in 2022, especially that last quarter. It was just madness because the deals were just so great. But it's 2023 now, and honestly, who the heck knows what's going to happen this year? So I'm going to give you my exact plan to take advantage of 2023 exactly like we were able to take advantage of 2022. But slow down. It does come with one massive warning that you absolutely must hear, or it could just completely blow up your portfolio and just make 2023 a disaster. So we'll cover all that today, and I just ask in exchange for you to gently tap that like button and consider subscribing too. It's super easy to do if you like the truth without the hype. Now, something big is coming on Sunday, and you guys asked for it, so you're going to get it. Again, it's probably the most requested thing I've been asked for on this channel, so it's going to be revealed on Sunday, so make sure you check out that video when it hits. So for this year, I'm going to use a simple 4-step process to basically lay out exactly how I'm going to execute this year. And honestly, guys, with all the chaos, with everything else that goes on in the stock market, there is no reason to have this complex plan or all these crazy 475 different steps to do this and then do that and all these little, I don't know, algorithms and charts and all these other crazy things like that. You know, you ask Warren Buffett his plan for buying, and he basically says something like, I plan on buying great businesses at fair prices, and if I can get them undervalued, hey, great. And that's kind of his plan. You gotta keep it simple. And that's the reason why I try to keep it simple with my planning. Now, some of the steps within it are complex. A lot of the things in finance and with stock investing and a lot of other investing are complex as well. However, your plan should be easy to execute because you got all these other complexities going on. When the heat comes on, when the emotions are high, when everything's just going in total chaos, you need to be able to just calmly be able to refer to your plan and execute and have it just be as simple as can be. And that's exactly how this is broken down. So step number one is I will take what the market gives me. You don't have to play their game at all, guys. They will give you opportunity. There's no reason to play their game and try to just run around and move, rotate to this and rotate to that and do all these other crazy things. Don't play their game. They always have and always will provide you with an opportunity if you choose not to play their game, and that's the key there. So, Luke, what the heck does that mean exactly? That didn't give me a whole lot there to work with. What I mean by that is continue to buy undervalued assets based on valuation. That's it. And guess what? You gotta be patient with it too. The reality is, what is going to be considered an undervalued asset based upon a valuation is going to change over time. And you look a little further than last year. Basically, small caps just got destroyed. And to me, it was a giant gift. But they were the ones getting destroyed while other stocks were riding high. And then kind of as the year went through, all of a sudden, it was big tech that was getting destroyed and other stocks were riding high. More old man, McDonald's and Coca-Cola and everything else are flying to the moon. And all of a sudden, big tech they're the worst stocks ever. They're going to zero. The narrative completely flipped on those. That's kind of what I mean by this, is basically buying big tech at the beginning of the year wasn't helpful because that wasn't where the deals were. Big tech wasn't crashing down in June like a lot of the small caps were, where they actually made their bottoms was in June. That's where the opportunity was then. And then as more opportunities presented themselves further into the year as we continue to go, that's where those opportunities came. There was good opportunity in Tesla in June. There was an incredible opportunity with Tesla at the end of December and beginning of January. Kind of shows you the difference there. Same exact thing. Meta had its big fall, and then Google fell, and then Amazon fell. Apple's really the only one that's been able to hold strong through it all. But the point being is that what is going to be available to you is going to rotate from small caps to mid caps to large caps. And honestly, this year, I think it's going to rotate again to where the deals later on in the year are going to be more of those large cap old man type stocks, dividend style plays, stuff like that. If the market, continues to improve and if the economy continues to improve towards the end, through the end of the year, guys, not making any short-term predictions or anything, through the end of the year, you're going to see that money flood from those safe plays, like those large cap stocks, those dividend plays, all those stocks like that, into some of those smaller plays, which of course means those large caps are going to come down. I'm sorry, I don't have any interest in buying small caps and mid caps whenever they're on a crazy streak run, whenever they're way, way up. I want to buy them whenever they're beaten down, and vice versa. I have no desire to run to safety and rotate to defensive stocks when they're at all-time highs based upon valuation. Which kind of leads me to the next point, which is I will put in the work and have price targets for each stock I want to own Even overvalued large caps, I'm still going to put in that work and know exactly what my price target is and exactly where I want to buy it. You honestly can't execute on number one if you don't even know what the valuation is in the first place. You got to put in the work and figure out exactly what the valuation is of the stock. You got to have a price target, and then you got to actually know what you own. You've got to know that company intimately. So when the price actually does drop and the narrative is negative and the media is telling you the stock sucks and it's the worst thing ever, if you know that stock intimately, you know that that's garbage and that's just the media narrative, and you need to be buying that stock. I mean, Meta was a dead company just back in November. It was dead. It was in the 80s. It's the worst company ever. Oh, never going to turn it around. They're just going to die and go away. All these other things are taking over, TikTok, whatever. Anyways, that was the narrative then. And honestly, they were still printing cash. They were still, even with all the metaverse stuff that he was ridiculously over the top on, they were still printing cash. And as they started making changes, which he had a meeting shortly afterwards where he basically said, hey, yeah, we spent too much. We're going to cut some staff. We're going to do some other things, which kind of got the stock momentum moving the other way. Now, all of a sudden, it's a great business. And all of a sudden, everything's positive and the news is all positive. And now people are wanting to pile into it. But it's already up almost 100% or right around 100% or so from that bottom low. I was pouring money in at that bottom low or around that. Of course, I never hit the bottom because I just can't do it for the life of me. But I was buying, under $100 as much as I could because I understood the stock intimately. I understood what I owned intimately and what the opportunity was there if Zuck, basically pulled his head out of his, backside and figured out, hey, I can pursue this, but I need to also be growing the business as well and the other lines of business that do incredible and gangbusters and cash flow and print money. And he figured that out, said all the right things on this last earnings call, even though it was a miss. And now you see Meta is set up for a great runway over the long run with this stock. That all comes with intimately knowing the company themselves, having a valuation, having price targets, and knowing when something's undervalued, then really undervalued, then just stupid undervalued, and just, Wall Street stupid whenever it got down to those bottom line prices. That's what happens when you implement step number 2. Step number 3 is I will continue to raise cash during these slow times and look for ways to increase my income or reduce my expenses, or in the best case, do both of those. Basically, since the beginning of January, I honestly haven't made any buys in stocks due to the just ridiculous run-up that happened. All my stocks ran up so quick, so fast. It was like, oh, okay, wow. All of a sudden, I just wasn't as encouraged to buy because the run was so quick. And that's okay. It meant I got to replenish some of that cash that I burned through the previous couple of months. And that's exactly what you need to be doing during these times. Whenever you have a great run in your stock or none of the stocks are to your price target yet, don't spend that money, be stacking that money. And then on the flip side, solve that money problem. We have tons of group members in my group who are basically stacking cash, taking on overtime, taking on a side hustle, taking on a second side hustle, house hacking to where now all of a sudden they aren't paying their mortgage anymore. Somebody else is paying it. That's a huge expense gone. If your mortgage is $1,500, $2,000, whatever the heck it is, if all of a sudden that's covered and somebody else is paying that, that's money that can go directly into Tesla stock per se. That's huge and it's recurring. It continues to happen. So continue to look for ways to do that. And of course, reduce your expenses down. Get rid of some of the crazy stuff like the $18 Chipotle burritos. I'm so crazy I had to pay $18 for one freaking burrito. It's insanity. But the point is there's places on all of our budgets, including mine, to where we could continue to make those cuts and get that lower so that way we can use that money not to spend, not to buy something cool, not to do something cool, but to invest in the stock market when those opportunities are up. And again, that's where increasing that income will pay off over the long run. Maybe your side hustle only makes you $100 a month, then maybe by the end of the year, it's making you $500 a month, but it could grow into something to where eventually over the course of maybe 5 years, maybe it's making $3,000, $4,000, $5,000. Maybe even you're actually able to replace your job with that side hustle. That was a passion that kind of turned into a job. Those things don't happen in a month, 3 months, 6 months. Those things happen over the course of years. And if you're willing to take that approach and take that seriously and implement that in your plan and be aggressive with it, not only now, don't look short term, look long term, it can really pay off long term in regards to your investing and also assist you in the short term. Hey, it's not a bad gig if you can only create an extra $200 a month. I can assure you buying whatever the heck stock you want to buy, every month, an extra $200 worth over a 20-year time frame will significantly increase your wealth over the long run. Now that wealth building only happens if you implement step number 4, and that is don't speculate. And I'm also going to ignore Wall Street, the media, and just stick to facts. I don't care about Michael Burry or what he says. I don't care about what economists say since they're wrong way more than they're right. I don't care about the latest hot stock. I don't care about if ChatGPT is going to totally crush Google and Google's just a terrible business now because ChatGPT, whatever the heck it is just going to crush it and go away. I don't care about any of that sort of stuff. The hardest part when this market turns green, I don't know if it's going to turn green next quarter, at the end of the year, beginning of the year. Have we already turned the corner? I have no idea. I know that one of the hardest things to do when that market turns green is to not speculate, but I'm not going to do it. There's going to be YouTube videos and all kinds of other things showing, I bought this stock and it went at 300%, and I bought this and it did that. That sort of things happen as a market turns and as money flows in and as the speculators start to flow in. And unfortunately, it seems like, especially over the past 3 years or so, the speculators have kind of bubbled up to being kind of like the primary news and the primary target, especially here on YouTube and such, when there's tons of great companies doing great things and growing, that you don't have to play the speculative game to where, hey, that's great if you want to trade and you want to trade in that sort of stuff. I guess go for it. It's not my thing at all. But as long-term buy and hold investors, you've got to kind of ignore that sort of stuff and don't get yourself into that speculation, because at some point in time, the rug does get pulled. Even without the Fed, the rug gets pulled because, I'm sorry, a penny stock that all of a sudden was going bankrupt, 3 months prior, all of a sudden has, gone up 1,525%. But they haven't released anything. They hadn't done anything. They don't even have any real revenue. They have nothing except for a cool PowerPoint and a few other things like that. Still not a great company, regardless of how much the returns are. And probably at some point in time, there's going to be a rug pull in that scenario. So stay away from all that. Stay completely away from the media and the media narratives. Don't get caught up in all those sort of things. Even when they're positive, I still choose to kind of look at them with kind of a, whatever you want to call it, speculative eye, whatever the case is. And honestly, I don't listen to it all if it wasn't for, you guys here on YouTube and my group. I wouldn't listen to any of it. I don't watch it. I don't watch CNBC. I don't watch any of the news channels, Fox, CNN, you name it. I don't watch any of it because I don't need that sort of stuff. It's all coming with a bias, a slant, a reason. And oh, by the way, very, very rarely are they actually just, the fundamentals of what the heck's going on with the companies that I'm looking at themselves, because that's boring. It just is. And that doesn't sell. That doesn't get clicks. That doesn't get subscribers. That doesn't get all that other stuff like that. So I choose to ignore it, and I stick with exactly what I know, which is looking at the earnings calls, listening to those earnings calls, looking at all the filings, reading through all those, and then making a distinction, and then looking at the stock and what the heck it's doing based upon, valuation and where my price targets are, and then making decisions there. Everything else to me is just noise meant to distract me and to keep me from making the best decision possible for myself and for my investments. But there is one big warning that all of you guys absolutely have to avoid. I mean, regardless of anything else I've said today, even if you don't want to have a plan, great. You want to implement your own plan, take pieces of mine, create your own. That's awesome. But one thing can derail everything. I mean, even if you decide to lay out a 47-step plan for, X, Y, Z, and you've got everything lined out to where it's just all automated, you put it on a ChatGPT, I don't know, whatever the heck automation, I don't know what the heck going on with all that sort of stuff. Doesn't matter. The point is, regardless of where that's at, if you do this, you are going to lose and your portfolio is going to be crushed. And that is if you let emotions into your investing. Emotions absolutely crush your investing, and you saw that last year with a huge downturn in the market and what it did to, and I'm just going to use YouTubers. I'm not bashing anybody. I'm not saying anything, I got anything right or anything else like that. I'm just saying you saw emotions take over a lot of YouTubers who were all in, bullish on Tesla per se at 400, 350, buy it, 400, buy it. And then all of a sudden it's down to 100 and they're basically like, sell, get out. This thing's going to, whatever the heck, 40, 60, 20, whatever that. It's crazy what some of the numbers were and such. That was pure emotion. That was not based upon fundamentals. The company continued to perform underneath. There were really no real issues outside of Elon's little flirtation with Twitter and however the heck you want to take that and all the selling involved to buy Twitter and some of the costs that are associated with that he has to sell Tesla in order to buy Twitter. Outside of that, everything else fundamentally for the stock and the company was great. The only thing that changed was share price. But when that share price changed, it took over people's emotions, just like whenever it was going up, right? I guess it's the same way. It's dangerous both ways. When the stock was going up, emotions took over. And I'm sorry, I wasn't buying it at 400. There was no chance. It just was overvalued. Great stock, great company, overvalued at the time, in my opinion. 350 the same exact way. I wasn't touching it at those levels at that time because of that. And same thing, as it went down, so of course, emotions are feeding people thinking, well, I bought it at 300 and it went up to 350, and then I bought it at 350, it went up to 400, and it just, the emotions kind of take over and you think it's going to continue to go on forever. And same thing, whenever it came down, now all of a sudden, all the bullish arguments and everything else are down, and now all of a sudden the bear side, which was there when it was at 400, all of a sudden at 100, they're screaming at you. And they seem more probable than the other ones when the exact opposite was actually true the whole time from an investing standpoint. That's the reason why I would talk about valuations and having a plan and all those other things in the first place. As long as the fundamentals were intact, which they were, I had no reason to not buy more at that lower price. As a matter of fact, I was super pumped about it. Sure, it could have gone lower. And of course, it went lower from when I first started buying, which means I need to buy heavier if you really, want to own more of that stock. And I did want to own more Tesla at those prices. So that's exactly what I did. The only way to explain all that chaos with all the YouTubers, the media, and a lot of folks out there was emotions. It was pure emotions, and that was it, which is probably part of what's driving the rally up right now is that exact same emotion. And that's okay. I'm just telling you, it can completely derail you. And we saw very real examples, honestly, some heartbreaking examples very publicly here in the YouTube space of people that absolutely, got twisted upside down with their emotions and made some of the decisions that I'm sure in hindsight, they probably wish they wouldn't have made. And you can say the same thing on the high side and on the low side. And it really sucks, but it's a great reminder for all of us to learn from that and kind of go, hey, we've got to keep emotions out because that can absolutely destroy your investing. So hopefully this made sense, was helpful. And if you need help with valuations or creating a plan or anything related to stocks, make sure you sign up for my group where you can take 5 courses for free and, basically several hundred tutorials or so that you can go through, have an entire group of 6 and 7 figure investors, more than 1,000 of us in there, actually help you develop and build that sort of stuff and build those skills so that way you can keep those emotions out and execute your plan. And click this video here if you want to see the most important stocks in the stock market, and click here if you want to see exactly what I've been doing in this market. So thanks for watching, and we'll see you in the next one.